Last week, it was revealed that Michael Burry's US stock portfolio had shrunk by over 50% to just over $50 million. He sold out completely from 11 of the 16 stocks that he previously owned and only added 5 new investments. But even more interesting is that the total assets under management at his fund remained about the same, so he's either increased his investments in other assets and countries, or like Warren Buffett, he's sitting on a huge pile of cash. But regardless, there are some fascinating stories behind some of the changes he's made to the portfolio, some of the stocks that he's sold out of, positions he's doubled down on, and 5 brand new investments, 2 of which now represent nearly 30% of his US holdings. But let's start with Burry's decision to sell out of most of his investments. HCA Healthcare, Citigroup, Sprott Physical Gold Trust, Block Incorporated, Cigna Group, Advanced Auto Parts, BP, Vital Energy, Star Bulk Carriers, First Solar, and Safe Bulkers were all missing from the latest SEC regulatory filing. Together, these stocks represented almost 70% of his US stock portfolio. There's 2 notable names in that list. The first is Sprott Physical Gold Trust. At the end of the previous quarter, it was his 5th biggest US stock, representing more than 7% of the holdings. I spoke about this in my last Burry video because it seemed like a pretty obvious bet on trouble occurring in the economy. Gold is considered a safe haven during times of crisis. When there's been a sharp slowdown in the economy, many investors flee the uncertainty of businesses and put their money in gold. Sprott Physical Gold Trust is one way to own some gold without having to store the physical metal yourself. Instead, Sprott holds your gold at the Royal Canadian Mint, and if you want, they'll even let you exchange your shares for delivery of actual gold. This makes Burry's sale of the stock actually rather interesting, because we don't know whether he simply decided he doesn't want to invest in gold anymore, or whether he's redeemed his shares for the physical metal, which he is not legally required to disclose in public filings. The other notable stock he sold was HCA Healthcare. He first invested in the company at the end of 2023, and while we can't know the exact price he paid, he would have made between 13 and 55% on it in under 6 months. The company owns and operates hospitals and surgery centers around the US and United Kingdom. It's a high-quality, well-run business, growing consistently year after year, and it was pretty reasonably priced. But this quarter, Burry found something even better in the healthcare industry. He sold out of HCA and put all the money into Molina Healthcare, about 14% of his US portfolio in just the last 3 months. They provide healthcare services to low-income Americans under the Medicare and Medicaid government assistance programs. The stock has performed extremely well for years, but in March of this year, it hit a major roadblock, falling 30% in just a couple of months. It was during this decline that Burry made his investment. And while the stock did keep falling, just last month, things turned again, up 20% in the last 4 weeks. I want to show you some of the numbers behind this stock because they help explain why Burry suddenly exited his other healthcare bets and went heavy into this one. And as we dive into the numbers behind this company, I'm also going to tell you about the sponsor of today's video, Stockopedia. This is the Molina Healthcare stock report. It's one of more than 35,000 global stocks tracked with institutional quality data that will help you uncover hidden gems. Molina has grown revenues and profits very consistently at around 10 to 12% per year. Book value has grown at 21% per year as the company reinvests most of its profits back into the business and earning a 20% return on capital. One of my favorite features of Stockopedia is their proprietary stock rank system, which simplifies all of this financial data into rankings based on quality, value, and momentum. 2 of Burry's biggest investments, Alibaba and Baidu, are some of the highest ranked stocks on the site. I'll be talking a little bit more about these companies later in the video. Molina scored a 97 out of 100 for business quality, which is no surprise, given their strong growth and internal return on investment. For value, they're about the middle of the road in terms of cheapness. They have a forward price to earnings ratio of 14. The traffic light colors make it easy to see that this is better than most of their industry peers, but about average when compared to all US stocks. Molina is also in great financial health, scoring 8 out of 9 on Stockopedia's health trend scale, and they fall into the safe category on the Altman Z2 score, which evaluates bankruptcy risk. These indicators, as well as the M score, give you more confidence in your investment decisions by identifying potential risks and exposure to losses. The stock even qualifies for 3 different guru investor screeners: Joel Greenblatt's, Richard Bedard's, and one of Warren Buffett's. These guru screeners are actually based off the investing styles of proven investment legends. So for example, we know that Warren Buffett screens will typically focus on a return on equity greater than 15%, growing operating profits, and margins above the industry average. You can of course create your own screeners using more than 350 metrics to find opportunities based on your own criteria. But it's in the portfolio analysis tools that we can really see the way Burry thinks about investments. You can use this to build and monitor your own portfolio allocation, but I also made one for Burry's portfolio. In the bubble chart view, we can visualize the 3 different types of investments that he targets. High quality businesses that are reasonably cheap, Molina is in that group. Then the lesser quality businesses, but they're further to the right, which means they're quite cheap. And then there's that, which looks like a horrible investment. This is one of Burry's new investments. The dot size means it's a small investment, but it's a very interesting one, which we'll take a look at in a minute. If you're interested in unlocking a world of powerful insights and cutting-edge tools, my audience can get a 20% discount and a 14-day free trial on any annual Stockopedia plan by using the link in the description or entering the coupon code HH20 at checkout. And if you have any questions, feel free to drop them in the comments below. In total, Burry added 5 new stocks to his portfolio: Molina, which we just covered, Shift4 Payments, Hudson Pacific Properties, Olaplex Holdings, and BioAtla Incorporated. BioAtla stands out like a sore thumb. It's a tiny biotech company trying to develop drugs for cancer therapy. It has no revenues and has been very quickly burning through its cash reserves. Not exactly the kind of stock that you would expect to find in a value investor's portfolio. Remember Buffett's rule number 1 of investing? Don't lose money. This is like the complete opposite of that. Almost guaranteed to lose money. So why is it in Burry's portfolio? Well, one of the drugs BioAtla was developing was set to have phase 2 trial results released in May. Phase 2 is where they test the effectiveness of an experimental drug with a small group of volunteers. If the results turned out to be really good, then it could be a catalyst for the stock to surge. Well, they released their results, and the results were, I'm actually not sure if this is good or bad, but the market didn't like it. The stock fell 50%. Since we know that Michael Burry invested in the stock somewhere between April 1st and June 30th, it's very likely that he was just making a small speculative bet on the success of this particular drug trial. There's also a few other drugs currently in phase 1 or 2 trials that have results coming out later this year. But I wouldn't be surprised if this stock was missing from the next quarterly SEC filing. For all we know, he might have already sold it. Buying stocks like this is much closer to gambling than it is to investing, unless you have some deep industry knowledge around this stuff. And even then, if a drug they're developing is highly likely to succeed, the market will already reflect that in the stock price. But let's shift focus to Burry's biggest investment. No pun intended. Shift4 Payments is now Burry's 3rd largest known investment, almost 14% of the US portfolio. As the name suggests, the company provides payment processing solutions to businesses. They sell a full suite of products and services such as point-of-sale devices and end-to-end payment processing that can consolidate in-store and online sales through one payment platform. Most payments in the US are processed by either Visa or MasterCard, but there are many different payment businesses that give merchants the tools to allow them to accept these payment methods from customers. They mostly make money by charging fees on the volume of payments and per transaction. But most of this money ends up going to the bank that issued the credit card to the customer, and then the bank then passes that money on, or most of that money, to either Visa or MasterCard for actually processing and authorizing the payment. In fact, after taking into account these costs and their other operating costs, they don't actually make money from the payments themselves. The profit is mostly from subscriptions that they charge their merchants for using their point-of-sale devices. So this kind of business is really dependent on scale. They only reached profitability in 2022 when they processed more than $70 billion worth of transactions. One reason that Burry might have invested in this company is the potential for it to be bought out by a larger competitor. In the last few months, founder and CEO Jared Isaacman had received multiple bids for the company to be acquired, but rejected them because they didn't sufficiently value the firm. They're also putting a good portion of their profits towards repurchasing shares. They recently authorized a $500 million program. The worst part about the company is definitely their balance sheet. They had $3.4 billion of assets, but most are intangibles such as goodwill. Goodwill assets are created when Shift 4 makes an acquisition of another company, something that they've done a lot of. It's not something that is inherently bad, but investors generally will disregard it when evaluating the financial health of the business. If you remove goodwill from the balance sheet, Shift 4 has more liabilities than assets, primarily $1.8 billion in long-term debt. The bad news is that most of this debt is due in the next 2 years. If it's refinanced, they'll likely be paying much higher interest rates. The good news is that it's convertible debt, so if the stock price continues to rise, they won't have to pay it back. But bad news again, if that does end up happening, it will ultimately increase the number of shares outstanding, reducing the value of each share, so it could end up being bad for investors anyway. Burry also doubled down on bets in Chinese tech, increasing his bet in the Alibaba group by 24% and making it his largest US listed position. A few names down, he almost doubled his bet on Baidu, the owner of China's dominant internet search engine. He did reduce his investment in JD.com by about 30%, but it remains a large bet. Besides Molina Healthcare, Burry's 3 Chinese bets are the only companies that make it into the high quality and cheap category on Stockopedia. They've been horrible stocks to hold since 2021, and it can be largely attributed to the economy. China is facing one of the worst property crises on record, and with a large chunk of citizen wealth tied up in the sector, it's been extremely tough on consumers. And while this has certainly impacted the growth of these companies, they are still growing and producing a ton of free cash flow. So the investment really comes down to whether China's economy recovers in the next couple of years, and also the other looming macro risks, the potential for further clamping down by the CCP on large businesses, and the geopolitical risks of worsening tensions between the US and China. The biggest piece of Burry's portfolio, as always, is unknown to us. The SEC regulatory filings only allow us to see US stock positions. And we also get a dollar figure for the total assets under management. So we know Burry is managing another $132 million, which is held in assets other than US stocks. That's almost 70% of the whole portfolio. It's pretty likely that at least some of this unknown part of his portfolio is invested in stocks outside of the US that he doesn't need to report, but it could also include other types of assets. It could include bonds, property, commodities like gold, and of course it could include cash. But unless Burry reactivates his Twitter account, we won't know whether he's sitting on a pile of cash like Buffett, or whether he took his money out of US stocks and just put it into other investments. Let me know your thoughts down in the comment section, subscribe if you enjoyed, and consider checking out one of these videos next.